In this lesson, we're going to look at the 3 key rules of position trading. Most traders blow their accounts not because they're picking the wrong direction, but because they break one of these 3 simple rules. Today, I'm going to show you the 3 evergreen rules that protect position traders from blown accounts. They're not complicated, they're not sexy, but they're the difference between surviving the market and becoming another statistic. So let's dive in and have a look. Position trading without a stop loss sounds crazy to most traders, but when you understand these 3 rules, you'll see why this approach actually reduces risk rather than increases it the vast majority of the time. Traditional trading tells you to use tight stops, but what happens? You get stopped out on normal volatility, you take loss after loss and watch the market move in your intended direction after you're already out. Position trading flips this. We use DCA, dollar cost averaging, to scale into swings. This is the type of strategy used by bank and institutional traders to move money in and out of markets, so it's totally normal within financial institutions. We do not use stop losses. They do not use stop losses either. But that doesn't mean there is no risk management. In fact, the risk management is more strict, and it all comes down to 3 rules: size, spacing, and exposure. If you break any of these rules, you're basically just gambling. Follow all 3 and you're protected. So let's break them down one by one and have a look at them. Size. So rule number 1 is size. Here's the exact formula I recommend as a basic rule to get into position trading. We risk 0.25% of our available balance over 1 ADR of movement. ADR stands for average daily range. So what we're going to do is we're going to enter a trade. We're going to risk 0.25% of our balance if the market moves 1 average daily range against our initial position. So let me just say that again. It's 0.25% over 1 entire daily range of movement on the symbol that you're trading. Not 1%, not 2%, 0.25%. This sounds incredibly small to most traders, and that's exactly the point. We're not taking one entry and hoping that it works. We're scaling in and out of market movement, and we're building a position as the market moves against us, if in fact it does move against us. So how does this protect you? Here's why this is so critical. When you position trade without stops, the market will move against you. That's not a maybe, that's pretty much a guarantee with most of the trades that you're going to get into. You're DCAing into swings, which means you're deliberately adding to positions as they move temporarily against you. And the important thing to remember there is temporarily. Yeah. If you're risking 1 to 2% per position, like traditional trading techniques will teach you, you'll be underwater incredibly fast. But at 0.25%, you scale in with 4, 5, or 6 trades within a position, and you'll still be within normal risk parameters. This small size is what gives you patience. You don't need the market to turn around immediately, and you can wait and add and build and let that market volatility play out while it's waiting to go in your direction. Rule number 2 is spacing. You need to space your entries apart by a multiple of ADR. For multi-day position trading strategies, which is what we tend to focus on, you can use somewhere between 0.5 to 1 ADR of distance between your entries. This allows the market to breathe and move throughout the day and tell you whether or not it has any indication of going in your desired direction. If it does, we can obviously take the profit on the trade. If it doesn't, we can wait for the market to move and then scale in with more positions. So we don't set specific pip distances. We use the average daily range, which is a dynamic measurement, to decide how far apart to space our entries on each symbol that we trade. We don't get in just when we feel it's right to get in. A specific calculated distance based on the instrument's normal daily movement is what works the best. So how does this protect you? Spacing is what prevents you from overtrading and clustering your risk too close together. If you're entering every 20 to 30 pips, you're essentially putting on one big position disguised as multiple small ones. When the market reverses, all of those entries are essentially at the same price level. But when you space by ADR, you're ensuring each entry is genuinely different. You're buying at meaningful different price levels, and it means your average price improves significantly every time you add. You're not just rushing to fill your position, you're using the market's natural volatility as a spacing guide. You avoid panic adding when the market drops quickly. Let me show you bad spacing versus good spacing on a real chart. I'm going to use the position trader EA to demonstrate how this works. So what I'm going to do here is I'm going to run two tests with the position trader EA. The first test, we're going to space our entries half of an ADR apart, and we're going to have an absolute maximum drawdown set to 10% of the account. So what this is going to show us is whether or not we hit a 10% drawdown on the account by spacing our entries half an ADR apart. So we'll start this test. I'll zoom out so that we can see the trades playing out in action, and we'll have a look at how this works. So you can see there that we've got 3 entries taken on a position which turned into profit. We have another 2 there which turned into profit. And now we are in a long position where the market is squeezing against us. We've taken 6 trades in total here, and the market's pushed back up and exited with a profit. So that's a test with half an ADR distance between the entries. Now, if I move that distance down to 0.2, meaning that we're spacing our trades at 20% of the average daily range instead of half the average daily range, we'll see what impact that has on the overall trades taken. So we'll restart this test over the same time period, and we'll see those same trades being taken again. So there's the first short trade and the second short trade, which turned into profit. And now we have our long position started. But as you can see, we're already in 7 trades. Now we got into 9 in total there, and we had to close the whole position out in one go because it hit the 10% drawdown target. So that shows you the difference of having a 20% and a 50% ADR spacing between your trades, and how that impacts the overall drawdown on your account. Rule number 3 is exposure. And this is where most position traders slip up, even when they nail the size and the spacing rules. Here's the rule. Diversify your risk to uncorrelated instruments and keep exposure to any one currency to no more than 2 to 3 positions if possible. This means you don't just load up on 5 US dollar pairs because you think the dollar is going down, or because you get a signal on 5 US dollar pairs at the same time with whatever strategy that you're going to run. You spread across different currencies and uncorrelated instruments and markets. So how does this protect you? Exposure management is what protects you from correlated blowups. And here's what I mean. Say you're short US dollar across multiple pairs. Your Euro US dollar long, your Pound US dollar long, your Aussie US dollar long, your US dollar yen short, and your US dollar Swiss short as well. You think you've diversified because you're in 5 different pairs, but you're not. What you have is one large position on the US dollar going down. If a surprise Fed announcement comes out, for example, and sends the dollar ripping higher, all 5 of your positions will move against you simultaneously. By limiting exposure to 3 positions or 2 positions per currency, and choosing uncorrelated instruments, which means that they move differently even on the same currency, you ensure that not everything moves against you at once. Some positions might be losing while others are winning, and this is true diversification. So how do these 3 rules interconnect? So here's what makes these 3 rules so powerful. They work together, each one reinforcing the others. Size keeps you patient and able to scale in because you're not getting in with too much risk on every single trade idea that you take. Spacing ensures your scaling actually improves your position as price pushes against you and doesn't over leverage you by getting in too close together. Exposure ensures one market can't wreck your entire portfolio or your entire account. So if you break one of these rules and the other two are in place, they're not necessarily going to protect you. Good size and spacing but bad exposure, one news event can wipe you out. Good exposure and spacing but bad size, you can't scale enough to DCA effectively and you'll get margin called. Good size and exposure but bad spacing, you will cluster your risk too close together and lose the averaging benefit and potentially go into drawdown far too quickly. All of these three together and you are protected. You can be patient, you can scale in, and you can weather drawdowns when markets push against you and let the winning positions run. This is why position traders who follow these rules don't blow accounts. It's not magic, it's just mathematics and discipline. So there you have it. 3 key rules to protect position traders from blown accounts. Size, 0.25% per ADR. You can play around with that if you want to. Spacing, half an ADR to 1 ADR between entries to let the market breathe. And exposure, no more than 2 to 3 positions per currency, and ensure that you try to pick uncorrelated instruments to trade. These aren't suggestions, they're evergreen rules. Break them and you're gambling. Follow them and you're protected. Position trading with DCA and no stops isn't reckless, but it requires strict adherence to these rules, and they are your guardrails. They're what allows you to trade without stops and still sleep at night. In the next lessons, we're going to dive deeper into how you apply these rules in real time, how to calculate your exact position sizes, and how to identify truly uncorrelated instruments. If you have any questions, you can drop them in the comments section below if you're watching on YouTube, or you can use the Ask a Question button if you're watching this on the website.